All right, everybody that's joining, as usual, appreciate those that keep coming back day after day, including on weekends, to the spaces that I do to try to help people get out of their echo chambers. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour, Miss Schneider, who I've known for a bit of time. I think we had dinner, I want to say 2-3 years ago. It was pre-COVID, Mish, which we'll reminisce a little bit about. But for those who aren't familiar with your background, Michelle, just introduce yourself. Who are you? How'd you get involved in markets? And what are you doing now?
Okay, well, first of all, hi, Michael, and hi, everyone who is taking their Sunday to join us. Thank you so much. Well, let's see. I guess the story really begins with the fact that I went down to the Commodities Exchange as a completely inexperienced person in terms of finance, right at the height of when inflation was going crazy 4 decades ago. So yes, I'm aging myself a little bit here, but it's okay. And I spent 14 years as a commodities trader on the floor. So I traded everything from coffee, sugar, cocoa to the metals. And I spent the bulk of my years in the Merc. So I was trading crude oil, heating oil, natural gas, went to Finex trading there for a while. And then finally, when electronic trading was becoming more of a thing than actual open outcry, which we know really doesn't barely exist anymore, I went upstairs and I began working with Market Gauge, which is my husband's company, Keith Schneider, along with Jeff Bish. And I really started becoming an educator in the not only of the different products that we had, but just in terms of how to trade and using a lot of the floor trading tactics that we had learned. All of us had been on the floor, and bringing it really more to stock trading from just commodities trading. And I have a background actually in special education. I have a master's in special education. So that kind of gave me a unique opportunity to not only teach, but also to think inclusively. And I created what we call the Economic Modern Family, which is one index, the Russells, and 6 different sectors. And really as almost with a family story with visuals, with actually images of each sector, a way to really teach financial literacy to pretty much everyone. And so, that and a lot of media appearances now. I've been all over the news in the last couple of years. Fox, Bloomberg, CNBC, Yahoo Finance, TD Ameritrade, et cetera, et cetera. And and then Michael and I did have a chance to sit down with Keith in Queens, New York for actually, I think it was a sushi dinner, Michael.
I want to say it was Indian food.
Oh, maybe it was Indian
food. As I recall.
Okay. Yeah. Well, anyway, we got to talk about a bunch of stuff, things that we had in common and interests that we had. So it's really such a pleasure to be here again with you all today and with you, Michael.
Yeah, no, it's great to reconnect. All right, so a few things you said I want to hear you expand on. So you mentioned you started off on the commodities exchange side 4 decades ago. How has commodities trading changed over the last several decades? Have moves become more accentuated, less accentuated? Have they become faster? Talk about some of the evolution of the commodity side here.
Well, again, and we don't have to keep reminding everybody how many decades ago it was, but yes, when I got started, and it was the best education a person could possibly have, was right at the start of 1980 when everything went crazy. And so at that point, commodities was all I was focused on because the equities market, the Dow Jones Industrial Average throughout the 70s had really sort of flatlined after it had sort of a run in 74 post the oil embargo. And then we went into a recession, and then it really basically ran up again because the Fed got a little more accommodative. And then, of course, we know that we went really nowhere until about 1982. So my experience was, you don't pay attention to equities. You pay attention to commodities because that's what's ruling the world. It was gold and oil and silver and soybeans and sugar. And then we switched sort of, after I left the oil market, particularly in 1990, now all of a sudden, obviously, the stock market was getting going. And we went through this big period of economic growth. And as such, the commodities market kind of died because raw materials weren't necessarily volatile at that point. They weren't in high demand, or at least there was enough supply to meet the demand. And that's kind of where we've lived until COVID, really. And so what's interesting about commodities right now is the whole idea of the commodities futures exchange, right, is for hedging. So it started in the 1800s with corn. So farmers could actually hedge on the futures market. So if they had a really bumper crop and they knew that the prices would come down in the corn, they could actually go short in the futures exchange and reverse. If they knew that they were going to have corn shortages, then they would buy in the futures exchange to hedge. And that's where it all got started. So what's so interesting is what we saw was as we got into 2019, even before COVID, I started to notice that these prices were so cheap in all these commodities, which of course, from my background, was logical conclusion that there just was so much still in terms of supply, but they had stopped producing. So a lot of the farmers cut back, a lot of the miners cut back because they were trying to keep the prices firm, right? So then comes COVID. And what do you see? We have now very, very low supply, and we go into that sort of, deep dive and everybody's staying home, and we come out of COVID, and then it was the perfect storm for commodities because you had labor issues, so people weren't able to be out there working and delivering. You had supply chain issues, as we know, really everything, including stuff just sitting there in the ocean or not getting off the shores of the different countries that produce commodities. And then all of a sudden, everybody woke up from COVID and demand went through the roof. And so commodities became really a focus for me again, 2020, after the March nadir into 2021. And now what we saw so far in 2022 is now that we're seeing equities coming alive a little bit from, and I know, Michael, we're going to discuss this a lot, whether this is a bottom or just a bear market rally, commodities have gone down again. And you have a lot of people saying, oh, that's it, it's peaked. But we know from experience that commodities by its nature are extremely volatile. So having a 20-40% move in any particular commodities doesn't necessarily mean they're dead. And what we saw this week is a lot of them starting to come back to life. So we're kind of really back to focus on a lot of these commodities after taking nice profits and then getting flat and now getting back in again.
What's interesting to me about the commodity cycle here is that it's almost like the turn for commodities coincided with the peak in this digital scarcity narrative around cryptocurrencies. There is such a demand for investing in something that has either a shrinking supply or not a much available supply that created these coded dynamics. And meanwhile, people forgot that real scarcity matters more than the digital scarcity.
Absolutely. And what's so interesting about Bitcoin is, by the way, that is our newest member of our modern family. When I say Bitcoin, I'm really using that as the pinnacle for all cryptocurrencies. But what is so interesting about Bitcoin in particular is that when the NASDAQ starts to outperform, say, the SPY, is generally when you see people coming into the altcoin space. And then when SPY starts to outperform the NASDAQ is when you start to see people coming into the Bitcoin space. So the conclusion is at this point, it's still a very speculative asset. And it also is very much tied to interest rates and growth versus value, whereas opposed to raw materials, we can't live without oil. We can't live without food. We can't live without all the things that go into our housing. And so that's really what we've discovered here through this post-COVID world.
And that point about hedging is an important one. Now, I do wonder, Michele, I want to hear your thoughts on, yes, commodity futures contracts, the whole point of them is really around hedging first and foremost, but obviously there's also a degree of speculation, and just like every other asset class, there's a lot of leverage also in the commodity space because of speculative bets. Are there any parts of the commodity space that you think have more speculation than hedging that maybe people should be thinking of in terms of avoiding?
Well, that's a great question, Michael. 98% of commodities and futures trading is speculative. Only 2% of anybody that trades commodities is actually going to take delivery on any of the commodities at the expiration of the monthly contract. So it is a speculative game all around, which is why it's so volatile and so much fun, by the way. So yeah, I don't know if there's any, people talk a lot about contango and backwardization and you should avoid. And, I don't listen to any of that stuff because natural gas is a perfect example. When I started talking about natural gas in 2020, and we started buying UNG. By the way, one big change of commodities trading from when I first did it, which was all futures, is that now you can actually trade an ETF. Is it pure? No. But if you're going to get a big trend like we've seen in natural gas and you're long an ETF, I don't worry about all that stuff. As long as you understand where you're getting in versus your risk, and you could take profits on the way up and catch a parabolic move like we did in natural gas, I think that commodities are going to get more popular as there are more and more ETFs, as long as we stay in this sort of potential second wave of a super cycle in commodities trading. Does that answer the question?
Yeah, no, it's just interesting to me that people forget the whole rule of commodities trading to begin with was not really to trade. It was exactly for the delivery point, right? I think that's an interesting aspect. But that does, I think, lend itself to another interesting question. And I know you're going to be a little bit biased in the answer here, but you can argue that from an asset allocation perspective, a lot of advisors, a lot of institutions for a long time did not really consider commodities to be a quote unquote asset class because it's an input, right? That pretty much goes into everything. And cynically, I'm always of the opinion that it's only an asset class when it's going up. So how do you think of commodities as an asset class in terms of, do you think that there's an under allocation if it is indeed something that should be part of an overall asset class? Just talk about how that positioning should, for most people, be considered.
Well, let's start with the beginning of 2022. I mean, what was the asset class that moved up over everything else while the rest of the market was moving down? And that was anything to do with oil and energy and gas, right? So anybody that was in the typical 60-40 type of portfolio, which means they probably were holding really virtually nothing. Maybe they were holding a couple of the big oil companies like Exxon in their portfolios, got killed. Because we know that bonds sank and so did the big growth stocks sank. And yet it was the energy market that was driving the entire move up. And so I think that with commodities, it's very difficult to say, oh, you should always have X amount of exposure. There are funds that will have, let's say, gold in their portfolio no matter what. I am much more of an active type trader. I'm not a real passive investor. So for me, in terms of how much holding we'll have in our portfolio at any particular point, and we do have a blended approach because we have a lot of quant models, and our quant models have switched more to equities lately. But I actually am looking right now at another opportunity for people who are, let's say, undervalued, or that's the wrong word, but not really holding commodities at this point. I think they have a unique opportunity to get back in, particularly right now into the precious metals. As we saw this week, there was a big gap up in silver and gold, and that gap wasn't filled. It held, and it closed on the weekly high on Friday.
All right, let's talk about quant models for a moment, because just looking at marketgauge.com, your site, and one of the things you offer are these automated emotionless systems. And I've said this many times on spaces and in presentations that there's really kind of three aspects to any type of investment strategy, right? One is your signal. Two is your look back period. So moving average, 20-day moving average, 50-day moving average, whatever it be. And then the third thing, which I think is really underappreciated by a lot of people, is the opportunity set, which is what you execute those signals, that look back period on. And the problem is you haven't really had any kind of persistent relative momentum in small caps and emerging markets really for a decade. Small caps relative to the S&P peaked around the time of QE3. Emerging markets, we know, have been a dog, right? Basically volatile cash for 10 years. When you construct models and have automated strategies, talk about the opportunity set that you often limit yourself to, because you have to limit yourself in terms of what you're going to rotate around if you have something that's quant-based.
True, but we have 6 different models, including a crypto pulse model, which has done extraordinarily well. We actually, all right, there's so many parts of this question, so I'll work backwards. The whole idea of having quant models is to have different ones, this blended idea. So we have a basic alpha rotation. So alpha rotation probably is our biggest macro, which means you're either long the indices, long the bonds, or in cash, essentially. So this was an amazing opportunity because after getting a little bit chopped up in that big macro model, after the whole move down, and then March, it kind of went sideways, and then we had the other crash. It got a little chopped up around that 50-day moving average. But now all of the indices got long over its 50-day moving average. And we haven't been in bonds in a long time. And we were actually, until this most recent period of clearing the 50-day moving average, was mainly in cash. But then we have country funds, We have sector rotation, which would go with any of the hot sectors, whether it's energy sector or semiconductor sector. And then we have, okay, I know we have more than that. I'm just off the top of my head. And then Crypto Pulse was something that we started out the year well, and then Bitcoin dropped and Ethereum dropped. And we didn't trade anything in the crypto space from April until about 3 weeks ago when we got into the Polygon Matic, which we just took a second profit on, was up over 80%, and Uniswap. So, it's interesting and then there's what I do, by the way, Michael, is discretionary trading. So discretionary trading gives us an opportunity if all the models are sort of gone heavily into cash. Oh yeah, we do also have a NASDAQ 100, which means we take the top 5 performing NASDAQ stocks and we get in on the basis of their trend strength indicator as well. So you can see we have a small cap model. Now see, all of a sudden my brain is waking up. We have so many things that's what makes Market Gauge really unique and very sought after by a lot of different funds that seek to trade our models, because it gives you exposure to many, many different things. So let's say your alpha rotation gets a little chopped up, but the energy market that we were in the sector rotation did phenomenally well. And then when all else sort of gets kind of in the murk, because the market is just going sideways, that's where the discretionary trading comes in, where I can get into something well before models would kick in, because I'm looking at it from a chartist perspective, from a fundamental perspective, from a macro perspective, and from an experiential perspective with a very low risk. Does that help?
Yeah, no, and by the way, that's I'm glad you mentioned that point about the whole point of having models is to have more than one model. I've made this point before, and the whole reason you want to have multiple models or multiple funds around the same kind of philosophy is because you want to have things that will be uncorrelated to each other in terms of the false signals, right? You mentioned the term the chopping up, right? The chopping up is getting whipsawed. So if you have one model, one strategy, one fund that's getting whipped around, it has false signals in a particular cycle. Well, if you have another tactical model that may not be getting whipsawed as much, that's actually diversifying the whipsaws, right? The false signals, the idiosyncratic aspects of your tactical approach.
Correct. Absolutely. That is the whole point. And that's why it's also important, we believe, at least at this point in time, to also have a good discretionary trading system as well, because it can, supersede and circumvent all of the chop or the trendlessness, or like I said, in the case of what I like to do is I like to be first into an emerging trend, because I can have this big top-down view. And also, by the way, included with oral models, we do have very specific risk-off, risk-on indicators that we use. We have a product called Big View, which gives us the whole picture of everything that's going on in terms of the risk indicators. So that helps as well, whether it's advanced decline, sectors that are outperforming, how the indices are doing. And you mentioned the small caps, by the way, and there's no coincidence that the Russell 2000 is the granddaddy of my economic modern family, because not that it has prevented me from buying the great bull market that we saw over the last decade, but it has always kept me feeling like when I get a good move in any of these other sectors that are outperforming the small caps, that it probably would be a good idea to take profits, because the small caps weren't really doing it yet. We haven't seen any real industrial manufacturing growth in this country vis-a-vis the Russell 2000 for a really long time. My eyes never go off IWM, is what I like to use as my sort of benchmark for the small caps.
Now, what's interesting also about small caps, I mentioned that relative to large caps, if you look at IWM against SPY, it peaked around QE3 in 2013. But what's utterly insane to me about small caps is that the ratio is actually back to, I think it's April of 2002 levels, which means that if you were in the midst of the tech bubble bursting and you said to yourself in April of 2002, I'm going to take a bet on the US market. I'm going to go into a very diversified basket. I'm going to go into small caps, which are much more sensitive to the domestic economy and have many more names than large caps. You've actually gone round trip relative to large caps. I mean, you have the same performance against the S&P since '02, but with a lot more volatility. And that's despite all the academic research around small cap premium effect, the idea that these areas tend to have more drift of momentum because they're less covered. I'm curious how you think about small caps relative to large caps over the last decade, because that's been one of those perplexing dynamics of this bull market. I mean, if you believe that small caps are a sign of a healthy bull market, you can argue it has not been a healthy bull market for a long time.
Oh, I would totally make that argument because there's a very big reason why we've had a much bigger outperformance from the big tech and the growth stocks. And that's because of a very accommodative Fed that goes back 40 years. So when you have interest rates going down and you have pretty much zero taxes on these big corporations, and then you have companies, because of all of that availability of paying no interest and paying no taxes, buying their own stocks back, these corporate buybacks, that's when you have this sort of false sense of a bull move that really has nothing to do with the actual reality of what's happening infrastructure-wise in this country, industrial manufacturing side of this country, especially since we have basically been buying our goods from China predominantly over many, many years because they're cheaper. So, yeah, I mean, if you really want to be nationalistic, so to speak, a movement towards creating more in America and really building our infrastructure and our industrial manufacturing side so that we actually create competitive goods here would put us back into major superpower in terms of the economy. And when you look at some of the performances of the United States versus some other countries, particularly if we just want to look at infrastructure, we're way down there on the graph. And so, yeah, we're talking really macro here, more philosophical. It doesn't really have anything to do with how you're going to trade on a day-to-day basis, but it is something that I watch constantly.
Yeah, and the clearest, most recent proof of that point about the domestic economy is, as the vaccine news was coming out, small caps really went vertical around early November, as I recall. Massive reports, of course, gave it all back, right? Mm-hmm. Which we'll talk about on a relative basis. But it is one of those areas which is interesting in terms of looking at relative momentum. But let's talk about that now in the context of the name of the space. And by the way, everybody that's here again, not only follow Ms. Schneider and check out her site, but feel free to engage. Click on that bottom left mic request button. I'm happy to bring you up. So I named the space "The Bear Market Ain't Over," not because I have broken English, but because I think it's just a funny way of framing it. And I was pretty loud on Twitter and in writings arguing that back in mid-June that the setup was there for a melt up and that it looked like capitulation the week of what happened to end up being low. Lucky or smart, I'll take it either way. But you've had a pretty sizable move, and I've made this point that small caps intraday bottom June 16th, which is also the same day that Treasuries TLT bottomed intraday June 16th.
And
so
junk bonds,
just like everything broke, and junk bond, everything. So just like everything kind of broke down in the same way, everything now, of course, is having a relief rally in the same way. And we had a pretty big run the last 2 weeks, and Friday after the close, I said risk off. And I said that because, at least from the signals that I track, utilities, lumber, treasuries, everything now is saying, again, the same message in terms of conditions favor potentially an accident, just as everybody now suddenly is getting maybe bullish. I'm curious, what are your thoughts on where we are in the bear market? Was this just a relief rally from your perspective? Talk about how you see this current movement here.
Well, this is where I like to go to like a 30,000 foot view versus, I like to say 7,000 because I live in Santa Fe and we're 7,000 feet above sea level, and then the sea level view. So if we look at the 30,000 foot view right now, that really is, to me, the major cycle of mankind in general. And I know there is other religions that talk about this, particularly Hinduism, but it's really basically where we at as a society at large globally. And we can go through these big periods of innovation, which generally lead to big periods of complacency. And then from complacency, we lead to a period of revolution. And we can actually obviously overlap at any given time, and we do because the world is complex. But if we make it really super simple, we have been sort of coming out of a tremendous period of innovation into this sort of, and then complacency into this sort of revolutionary time. And that's all I see everywhere right now, geopolitically in particular, is that people are questioning the status quo of everything, whether it's governments, whether it's the central banks, whether it's the media. Everything is under question right now. And so,
by the way, including definitions like the word recession.
Exactly. I mean, nobody's really working on the paradigm of everything is exactly exactly the way we've been taught. Everything has changed, and a lot of it came out of the pandemic, obviously, where people realized that, we woke up to the idea that, gee, nobody really took care of us because there isn't enough around for everybody and people are hurting. People are, even the labor department. And when I say the labor department, I mean the labor movement has shifted. People are saying, who needs to work? I can't make enough money if I work anyway. So I might as well just stay home and not work. The hell with them kind of thing. Them being, the whoever, the big the. So that's the 30,000-foot view. So I like to keep that in my mind because it's pretty obvious that's what we're seeing. If we go down to the 7,000-foot view, that's really where we're starting to see the current megatrends of inflation. Mother Nature's gone berserk. Nobody anywhere hasn't seen. It's obviously the flooding that we're seeing versus the fires that we're seeing versus the drought that we're seeing. And this is also a global situation. In terms of the geopolitics, we're seeing unrest everywhere. And then we also have this, this whole new generation. The baby boomers like my generation are starting to obviously decline in numbers as we get older, and the millennial generation is starting to rise. And so generationally, the whole way things are done are going to change. So I think if you look at all of this and you put this all together and then you bring it down to sea level, this bear market, if things don't necessarily change and we start to see Mother Nature continuing to rear her ugly head affecting raw materials, geopolitics and social unrest. Obviously, we know Russia and Ukraine is a part of that. Now there's this whole threat. All of a sudden, more and more buzz I'm hearing about China and Taiwan. That would be devastating to us, by the way, because our semiconductors come from there. So I do believe that one has to be extremely aware that there are bubbles all around us. But as traders, we also have to be aware of the fact of the very short-term opportunities. And right now, we're more risk on than risk off, given the fact of what you said, that the TLTs have bottomed, junk bonds have bottomed, small caps have bottomed. It looks like the growth stocks have bottomed. We just went through better than feared earnings with Apple and Amazon, or even though Intel and a few others Roku didn't do so well. And actually, a barometer of a disinflation environment and disruptive tech, Cathie Wood, ARK, is doing nothing through the course of all of this, which actually is some kind of weird indicator that right now it's probably okay as long as one of these other factors I just mentioned doesn't come back to haunt us. And I still think we're going into another inflationary cycle that will look a little different than the last one. But talk about the Fed. I mean, basically with the interest rates and the yields actually down, the big concern about the housing industry, which prices are still up, but in terms of sales that have gone down, if all of a sudden people say, you know what, I can get a mortgage now back under 5%, I better lock in now because I know this isn't going to last. We can get another surge in that, which would also help steel, lumber, copper. And, we're actually long copper from the bottom because we said, you know what, where else can it go at this point? The conditions fundamentally are still favorable to copper, and there's a shortage of it, not to mention EVs. So that's a very long-winded answer to say, I am cautious, and I do believe we can go down. But right now, you got to wait for some shoe to drop. And right now, we're in this sort of calm before the storm is what I think.
Yeah, and I'm glad you mentioned China and Taiwan because I remember prior to COVID coming here to the States, that I was just looking on Twitter. I was seeing all these videos coming out of China of people just literally passing out, and this kind of rumblings of some kind of disease that was starting there, and you'd see all this stuff tweets coming from out of China, and so I started just looking yesterday at what is Twitter and what are the tweets saying about China and Taiwan, and there are a lot of videos that almost make it look like an invasion is imminent by China and Taiwan. And then I postulated, I wonder if this treasury strength is maybe anticipating some kind of a conflict. I know it's obviously coinciding with Pelosi going, but when you think about geopolitical risks, and I know it's obviously nearly impossible to time this stuff, how does that, from a portfolio management perspective, cause you to change things up, right? So obviously you've got your models, you've got the discretionary side. Presumably this is more on the discretionary side. But how do you think about geopolitical tail risks like that?
I think about them all the time.
All the time, you got to, yeah, exactly.
But yeah, and as far it's interesting, you brought up the idea of the treasuries potentially reflecting a China-Taiwan topic, because listen, Michael, we've been hearing about China-Taiwan for years, but I've heard more about it now. And if what you say is true, one of the things you want to look for is you don't want to see TLTs outperforming the SPY, because that is definitely a risk off environment. And that's telling you that there's a flight to safety. I mean, bonds have been out of favor, obviously, because of inflation and because of a new QT by the Fed. But if in the light of that, you start to see the TLTs say outperform the SPY, and they're kind of almost on par right here, one more leg up in TLTs, and if the SPY sort of goes sideways, that could be your good signal to run for cover in terms of being in equities, but buy the hell out of commodities, and particularly those precious metals, I believe, because when all hell breaks loose, and people haven't seen it, we haven't seen how all hell break loose. I mean, even the last few wars we've had, they've been fought in a different way. This is a different type of war. This is a war that really sort of potentially threatens what we saw with Russia, Ukraine, our way of life, because it affects our raw materials, our real assets. If that's the case, right, run for cover in equities. And if you want to start making some money, you can buy the bonds, obviously, because in this case, it won't matter about QT. The Fed will not be able to keep up with what happens geopolitically and inflation. And clearly, in terms of credibility, we know the Fed has lost a lot of credibility, even by saying, oh, well, we don't even have a plan. We're just going to follow whatever the data points are for our next meeting in September. Yeah, I think that, Raoul Powell's been saying, oh, buy diamonds and buy bonds, and I know he likes to talk a lot in cliches and adages like that. But if he's sensing what you just said and what I'm sensing, yeah, I think that would be the signal right there. And there's a pretty easy way to follow whether TLTs are outperforming the SPYs. I mean, you can ask me. We have a proprietary indicator called Real Motion that tracks that, and a leadership indicator. But all you have to do is watch how the TLTs do versus the SPY, and you can pretty much tell, even if it's more innately, if that's starting to shift.
By the way, I'm so glad that you said that, it's TLT versus SPY is how you can really tell if it's real risk off. And in the first half of the year, that was not real risk off because treasuries acted like equities. Risk off actually looked risk on. I'm sharing in the space something I've retweeted many times. A lot of people probably have seen this, are probably sick of this chart, but it looks at the top 50 largest drawdowns for the S&P going back to 1961 using data from CRISP. And essentially what you see is that in those major drawdowns for equities, peak to trough, usually treasuries, TLT, are either up or down a lot less, and certainly not down big at the extremes when equities are down. So we have not really seen real risk off yet. That real risk off would manifest with treasuries rocketing against the S&P, where it's almost like an inverse of stocks during those periods. But that's what has made this such a frustrating year, because we haven't really ever seen a period in history where stocks, and in particular treasuries, look one and the same.
Exactly. And by the way, I was listening to Ray Dalio. I like to listen to him. He hasn't been always completely accurate, and sometimes he's like really super early, and he tends to be somewhat pessimistic anyway in general. And it's always good to know somebody's overall bias as a human being before you take what they say with pure acceptance. But in this case, he's actually echoing what you and I are saying, and a little bit of a different perspective. Let's get back down to the Fed. I mean, of course, there's the old "don't fight the Fed," but right now, that even that saying is strange, because what he basically said is that the Fed has never been in a more difficult situation than it is in right now. Because if it jacks up the rates and let's say we go to 6%, that's going to be disastrous for the market. But if they don't raise the rates, and they actually have to be somewhat accommodative to deal with any kind of supply to safety, that too is going to be extremely dangerous. So and I agree with that completely. And so I think that that's really what we have to keep an eye on too. I'm like, really, Michael, I think we just made it about as simple for people as you can possibly get it. which is watch that relationship between the long bonds and the S&P 500. I also, by the way, really love to watch the junk bonds, whether you like it through HYG or JNK. I have to tell you, it was the junk bonds that got me defensive right at the start of COVID in January 2020, not to mention the fact that I saw the small caps in my Modern Family underperforming. It's the thing that got me back into the market in April of 2020. It's also what got me out again in November of 2021, after you just mentioned that the small caps peaked at that particular time. And then when it bottomed out in June, it's what got me cautiously back into the equities market. And it also helped in terms of our risk off, risk on indicators, get the quant models long, particularly when we cross that 50-day moving average in the indices. So they have rallied. I'm calling them the MVP of this rally from June. Literally, if we just look at JNK, it went from 90 to 96.50 in just a few weeks. Junk bonds don't make that kind of move that fast. They don't. They go sideways sometimes for years. So what is that saying? I mean, right now, bond traders are piling into high debt, high yield companies. If that stops, along with what we just mentioned with the TLT and the relationship to the SPY, if that stops going up in terms of the junk and starts rolling over, I would be very, very cautious. So you don't have to really be a genius. You just have to watch those few things and that will tell you. And then, of course, the dollar is declining too, which is interesting because, it was a big flight to safety, by the way, throughout this whole down move. But also that was like super manipulated as far as I'm concerned. It seemed almost like a repeat of Bretton Woods, where the central banks were buying the dollar and back in the day it was selling the British pound. They were buying the British pound, and selling the gold. Now it seemed like they were buying the dollar and selling the gold. And that looks like that's starting to unravel too. So we're a house of cards, no doubt. But you've got a few things that you can really watch so that you're not caught with your pants down, so to speak.
Yeah, and really what you're hitting on is really what you're hitting on there is credit spreads. Now, one other anomaly I want to pick your brain on here is the anomaly of why gold has not performed better. Now, I've talked to a lot of advisors, a lot of individuals, and I think a lot of people are perplexed because on the surface, you'd think this should have been the perfect environment for gold to really run. And it did okay, but it didn't really justify 10 years of underperformance, right? Talk about how you think about gold, because you mentioned precious metals. Silver obviously had a big run last week, but talk about the role of gold in the portfolio and why you think maybe it hasn't done what most people thought it would.
Okay, so look, first of all, let's go back to 1980 because this is probably why so many people are perplexed. So you had the Dow, let's just call it 1,000 just to make it easy. And you had gold at its peak was 850. So it was basically like a 1-to-1 ratio from gold to the Dow. Now let's fast forward and you had the Dow over 30,000. So the Dow has gone up 30 times and the gold is basically a little more than doubled in value. So, that's a huge difference in the ratio of what's happened in the Dow versus the gold, which is why a lot of people think that the gold is really undervalued. And basis to the cost of inflation, it really is. But there's a few factors that happen with gold. Number one is there has been a tremendous amount of bank manipulation. I mean, there's a whole suit going on right now with JP Morgan and other banks. Two is that I really believe that we have a whole generation of people that have not really understood that gold can be a hard asset when things have gotten really bad. And even though we had this tremendous flight out of fiat currency in terms of emerging markets and into the dollar, even that is not sustainable because it's paper currency. So I think I'm actually, it hasn't done that badly. If you look back, I mean, it just basically just now recently touched down at that 1680 in terms of the continuous contract price of gold per ounce. That goes back like years of support. So, rather than play the head game of why or why not, I could just tell you from a technical standpoint, if you just look at the undervalue, if you look at the ratios, if you look at the credibility factors, is particularly with fiat currency and everything else, and you look at the fact that everybody thought Bitcoin was going to be the big hedge against inflation, and we're seeing that now more of a speculative asset tied to interest rates, it's possible that if everything you and I just talked about plays out, you're going to see Bitcoin rally as well, potentially. if it's interest rate sensitive, unless the Qs and the SPYs really go down. But in the face of all of that, you can still see a major move in gold, which is why you're seeing these people predict 3,000 an ounce. I've also seen people predict 1,400 an ounce. I just think right now, as an old commodities trader, I didn't sit there and think about all this stuff. Back in the day, there was no like social media, there was no iPhones, there was no news 24/7. I just looked at price and charts. That's it. And as a commodities trader, I can tell you is that when you get that level of a high volume gap up in gold off of a historical base that goes back 3 years, regardless of what camp you're in, you've got to say right now that it has upside potential unless it breaks down under the risk up that it had on Friday. Then you could say, this was a one-day wonder. And that's how I would play it, very simply. We're long silver, we're long copper. We're also, like in our quant models I mentioned, we're long a lot of equities. There's a couple of other trends that have emerged, obviously with government funding, EV space, some, the solar energy stuff. But yeah, I mean, that's my thoughts on gold right here.
The term manipulation's an interesting one because that's often used and thrown around a lot when it comes to gold and in particular silver. But let's face it, I mean, everything is manipulated.
Yeah.
There is no free market, right? and by the way, it's funny because I always hear people saying, well, how does the Fed, being such a big part of the market, manipulating the market, impact any kind of model-driven approach? And my response is, well, the Fed has always manipulated markets going back to its founding. The whole purpose of the Fed was to manipulate the tail risk of banks going under. It's just they've never, had, to the extent that we've seen, been as involved in markets. Now, where I'm going with that is when you think about creating models, when you think about trading, when you look at charts, do you at all factor in this idea that the Fed is manipulating everything? Does that cause you to have less conviction in a particular theme, or is that just one of those things where you say, you know what, that's a constant, and just like any kind of mathematical equation, if it's a constant, you don't consider it?
Yes. To the latter part of your statement. Yeah. I mean, I'm aware, of course. As I said, you got to look kind of like at the 30,000, and that would be more in the 7,000 view, which is, as a megatrend, we've had a Fed very accommodative, which has basically manipulated the markets to the point where we got before we just saw the most recent crash. But I don't use that in my everyday trading decisions, other than apart from what we just talked about, as I watch very carefully the different bond markets and the curves and all of that, and particularly and most importantly, the TLT versus the SPY. And also, you want to watch the SPY versus the gold. By the way, getting back to gold, if the gold right now is still underperforming the SPY, if that flips on the face of everything else, I don't care what the Fed does in terms of a manipulation. There's money to be made. Otherwise, you would never trade. You would never make money if you were afraid of all the manipulating forces out there. You would just be what they say, analysis paralysis. That's not a good way to be if you want to make a living as a trader.
Yeah, no, for sure. Again, let me just prompt everybody here. Please make sure you follow Michele Schneider and check out marketgauge.com. All right, I want to go back, Mich, to the economic modern family. You mentioned the 6 different sectors that you focus on or that are part of that family. What are those 6 sectors and why are they particularly important for you?
Oh, God, they're everything to me. They have just done nothing but make me money or prevent me from losing money since I really created them, which was back in like 2014. So essentially, I mentioned the Russell 2000. I call him Granddad Russell. And if you go on our website, by the way, and you look up under the tabs of the Modern Family, you'll see their depictions. Also, I wrote a book. I'll plug my book for a second, Michael, if you don't mind. Plant Your Money Tree. And that talks a lot about, by the way, phases using the 2 simple moving averages on a weekly basis that can be applied on the daily basis, which is the 50 and the 200-day moving average, and talks about how the Modern Family is used for a good macro. So the Russell 2000, we know everything we just talked about, but he's got a wife, and that's Granny Retail. And I made her a grandma. Again, I'm a storyteller and a former special ed teacher, so I like to think in things very simply so that people can really understand. And if you think about little Granny in the mall, right? We all have seen our little old ladies at the mall with their leisure suits, and so it represents really the consumer part of the economy. And that's 70% of the gross domestic product. So if we just go to those 2 for a moment, if we look at the charts, and I like to look at the weekly charts to get an overall macro sense, they have both cleared back over a 200-week moving average. So right now, yes, they're showing relative strength compared to where they were in June. They're running into resistance, and retail is doing worse than the small caps, which you sort of pointed out that the small caps are actually doing better. But then they have, we call them grandkids. We never created a mother and a father for some reason, but biotechnology would be one. And the reason why biotechnology is there because it's a very interesting look-see because it's both a cyclical sector and a non-cyclical sector. So that's why actually biotechnology bottomed before anything else in the market did because of that non-cyclical component. We need our pharmaceuticals, we need our drugs, et cetera, et cetera. It's cyclical because obviously if the economy is doing well, then it also means that there'll be more money to hiring in some of these big biotech firms and more money for R&D, right? So right now, that kind of stopped really moving. It's just been going sideways in the last week with the equities going much higher. But it's flagging. So if it can get through 125, I think we'll see not only maybe another leg up in biotechnology, but it could be another sign that money's rotating back to there as opposed to some of these big growth stocks. And then semiconductors is a huge part of the modern family. Interestingly, it's only one of the six, well, actually two of the six that did not break the 200 week. And obviously chip technology is the digital future and a huge way to determine what's going to happen from a macro perspective. But it also, if it's outperforming, it can drag everybody up, but eventually looks around. And I call her sister semiconductors. And if Russells and consumers are not following along, it starts to tank. And that's exactly what happened in November 2021. The Russell started to tank. The consumer granny retail started to tank. And then it wasn't until we got into mid-January, that semiconductors looked around and went, wait a minute, and then it started to tank. So now it's actually doing stronger than everybody else. So we'll see. Do I think it can get to 260, let's say, if we're looking at SMH? Yeah. Could it also stop at 240 and start rolling over? Yeah. China, Taiwan, Michael, that's going to be a big factor there too. And then there's transportation. So transportation, if Stanley Druckenmiller says there are three inside sectors of the U.S. economy: the Russells, the retail, and the transportation. And it goes back also to Charles Dow. I mean, it doesn't really require a lot of thinking to realize that obviously if consumerism and industrial manufacturers is the supply side, you want to measure the demand side, you look at transportation. So the transportation sector also never really, in this bear market, and this is why it could be a great thing or it could be a horrible thing, never broke down that severely under that 200-week moving average. It's been like 1 week down there and immediately came right back. And now we're again running into this resistance here. And then we wrap it up with two others: the regional banks. I like to look at that as opposed to the big banks because you get an idea of what's going on in terms of borrowing and the local economies in more of the rural part of the US. And then finally, like I said, we have our cryptocurrency character as well, which is more like still trying to figure out where it fits into the economy. So if you put that all together right now, you can say that this was the most short-lived bear market and we're right back to doing great because nothing really broke down. Or you can say that it was so rushed to be bought down there because of the habitual buyers of these big dips, because of the fact that we have $25 billion worth of retail money coming into this market, unlike we've ever seen before. Or you can say that people were prematurely optimistic, and that means this next liquidation. And yes, $1.5 trillion was removed from the market on this move down, but could mean we ain't seen nothing yet. But right now we're looking not so bad.
Yeah, and that kind of goes back to that line I keep putting out, that bear markets make fools of bulls and bears, right? Because to your point, it's very hard to really know because in bear markets, it's quite volatile. You have these rip your face off rallies. Everybody thinks that it's over, and then suddenly the downtrend resumes. And that's why these environments are so tricky, even for the pros and even for the back-tested models.
Well, the pros have done terribly, actually. Yeah, right. The retail market's doing better than the institutional investors because they're not necessarily thinking about these things so broadly. They're going in and they're buying. I mean, we laughed about the meme stocks, but essentially the retail investor has been probably part of the reason why a lot of people don't even work anymore. They figure, you know what, there's money to be made in the market. And the market has been, well, let's just say anybody who stopped buying and got out has been buying in the last couple of weeks. It's probably doing okay.
Yeah, it's interesting to me that you didn't mention the energy sector among that modern family, and there, I think there's a logic to argue that you can't really have energy significantly outperform unless technology significantly underperforms, because they're kind of on two ends of the opposite style spectrum. But
Yeah.
kind of riff on that. Go ahead. Yeah.
Yeah. No. Great point. Great point. Okay, so yes, you just touched on two reasons why. Okay, so when I say the economic modern family, I really think that if you look at that, like you just said, you can see these different relationships, right? So right, the energy sector is rallying. Obviously, that's going to affect the semiconductors. It's going to affect the consumer, and it was what we saw, right? You know, with the prices of gas going up, and obviously the energy sector going up. People started staying home more, and that's why we started to see the consumer discretionary space really going down. People were just buying what they need and they were afraid. And obviously, we still have the recession looming, all that other stuff. But there are what I call relatives of the economic modern family. But I had to stop with some nucleus. I mean, right, we all have a nucleus family, but then we have the uncle that comes and everybody has a lot of fun. Or we have the cousin that comes and is like a real downer, like, oh my God, lock up your safe because, you know, cousin Jerry's here. And that's how I look at some of these other sectors. So with energy, that is definitely a cousin. And utilities, by the way, I call Uncle Utes. I refer to Uncle Utes in my book. And I say that if Uncle Ute shows up at the door drunk and happy, it's time to pay attention, right? So that goes back to our conversation about the interest rates, because we know utilities do well in a low interest rate environment. They're more of a defensive sector because, again, it's what people need, utilities. So, yeah, that's how I look at all these other things. But you can see, even without looking at utilities and energy and gold and, you know, all the other different influencing sectors, solar energy, blah, 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 you can see all of that through the economic modern family, because you can bet that if granny retail isn't doing well and transportation isn't doing well and regional banks aren't doing that great and the Russells aren't doing that great, then you know these influential characters, these external family members are a part of the reason why. And it behooves you as a good trader to say, okay, well, if they're not doing well, what's trending better and why? And that's where you go with your money.
By the way, Uncle Utes is, I would argue, perhaps the most important family member, at least in my world, to pay attention to. So I shared in the space the link to the 2014 Dow Award paper, which basically documents that going back to 1926, when the utility sector is outperforming the broader stock market on a short-term basis, generally stock market volatility tends to rise. And to your point, it tends to not only be a risk-off play, but also a signal of risk-off to come, which again is a little bit curious. It's been leading for a while, and it doesn't want to seem to, on a relative basis, break even in this pretty big advance that we saw the last several weeks.
Yeah, to me, that's a cautionary tale for sure. And so that's why I'm saying, you know, there's a few things you can look at, but the more you start telling people to look at, you know, my job is to try to keep it as simple as possible. And again, you know, this is where I go back to my special education. So, you know, one of the things I did as a consultant in schools is I would modify curriculum to pull out the most important or salient features of any particular lesson so that kids with disabilities could get something from it, you know, fully inclusive, right? That was my thing. And it's the same thing with the market. So that's why, to me, the simplest thing is to look at exactly what we looked at. TLTs aren't a member of my family, but certainly a very influential component. You know, we could say we can make it an aunt or an uncle, or we can make it any gender. We can make it a, you know, gender fluid if we want. The point is that yes, utilities is important. TLTs are important, but keep your eyes really right now. I'd say just keep your eyes on three areas: XRT, which is still underperforming, doing okay relative to the fact that it hasn't really crashed under its 200 week. But certainly in the rally that we experienced in the last week, we didn't see XRT move up that much, even with Amazon and Apple earnings. I think it's what held it up, but it certainly didn't rally much. IYT, which has enjoyed a better rally because gas prices have come down and consumer confidence rose a little bit. And then C, The small caps. If the small caps can't keep going, what is that telling you? That there's still trouble in paradise.
I think that's a good way to end the space. Again, everybody that's here, as usual, thank you for joining. Please make sure you follow Ms. Schneider. Check out our website as well. Check out our book as well. Spent a very quality hour with us, Mish. I'm so glad we reconnected. It's been a long time since I saw you, but I'm glad you're doing well and still rocking as you do. So thank you for spending the hour here with us.
Thank you so much, Michael, for inviting me. And thank you, all of you, again, for devoting part of your Sunday to us. And I look forward to seeing you all on Twitter. And Michael, I look forward to coming back to New York and hanging out with you again.
I'll be around. All right. Thank you, everybody. Appreciate it.